Good day, everyone. My name is Uttam. I am a senior principal in financial services, focusing specifically on risk and compliance in Infosys Consulting. And I also have with me my colleague Shishir, who is a principal, again, part of Infosys Consulting, focusing in risk and compliance. Today, we are going to talk about digitization and its implications for risk management, and why digital risk management is one of the key areas to focus in the digital transformation initiatives. So we all know digitization is everywhere around us. Any new product that you look at, there's always a digital twin, or if there are old products, they're now being delivered in a digitally compelling way, and you're pretty much attracted to that. Digitization has become a universal priority because the firms have realized that the laggards will be outperformed. Whoever does not embrace digitization will, of course, probably endanger themselves in the form of market share, revenue, or many other means. It's really a compulsion. Now, the digitization has also resulted in first mover advantage, like, for example, Rocket Mortgage has been there for a long time and has just been introduced recently, and it has been consistently been number one for the last few years in that area, and incumbents find it difficult to challenge that kind of a model, right? So digitization is also resulting in first mover advantage, and this is giving the incumbent firms a lot of food for thought. So there is a lot of digital transformation initiatives going on around us: digital banking, digital servicing or customer servicing, digital wealth management. And I would say there are many other forms of digitization, not just in financial services, but in all industries in general. The key point is that only 30% of these digital transformation initiatives have been said to be successful. I would say not that others are badly tumbling, but it is just that 30% of them clearly seem to achieve the target they had set for themselves prior to digitization. 70% of the projects or initiatives, they are doing it, but they don't really, they're not really hitting the metrics or goals that they are, they have targeted for themselves in the form of experience, value, time, or risk, right? So this type of value leakage in digital transformation is a cause for concern, and that might not help firms that are really investing get the benefits of digitization. So with this, what we are going to look at is, in digitization, when firms embark on digital transformation journeys, they look at many different things. Typically, the tone from the top is out there. The funds are there with the sponsors who probably spend generously on various things. Some of the key ideas that people do look at are what is going to be a digital strategy in terms of the customer experience, what type of products, how do we capture value, then how do we get talent to help realize this digital strategy. And digital product is more of an agile product development, right? You develop some, release some, test it out in the market, and come back. So technology and data, of course, are the bedrock because everything revolves around technology. Now, with all of this said, there is one key element that's probably people are not paying as much attention to, or are probably not thinking through as much, and that's actually risk management. So as risk management is, of course, embedded in a conventional industry setting or the financial services industry setting. However, when it comes to digital risk management, so when it comes to digitization, risk management really has to be very, very nimble, because the speed of transactions in a digital world are rather high. Similarly, the risk management also has to be as fast, And that's the reason we are today focusing on how digital risk management can be thought through in a digital transformation initiative, and not just for a digital transformation initiative, but for the entire risk management framework in general. Coming to the next part, where we are now, let's explore, how digital risk management can play a role in a simple digital service that a bank may provide to its customers. Take, for example, a payments journey. So when banks customers do try to pay someone, it's a very simplistic and a very trivial task for the customer. That's what they assume, because when things work in a digital setting, they don't really get stuck with anything. But from a risk manager's perspective, they got to think through, what are the things that can actually disrupt this smooth flow of a customer's experience. And for that, they need to have a view of, okay, is this customer directly interacting with the machines, or is this customer interacting with some staff as well? Generally, there is a frontline staff who, in the form of a relationship team or a contact center, who can talk to the customer if, maybe the customer can call them, or they can talk to the customer themselves, inbound or outbound. But where customer is actually using services directly, then these technology can trigger some actions in the, for the back office teams to do. Like, for example, when a person does set up a payment, then there are certain actions that get triggered in the background, like sanction screening, for example. Are these funds going to any sanctioned entity? So there is someone in the background who is actually looking at whether there is a sanctioned entity, and if this transaction is safe to move forward, right? So there are some teams which are involved in the background. And further, there are supporting systems, right? There are many different apps that support this particular journey. This could be a bill payment app, or a customer portal to begin with, where customer logs in. And then there's a customer support system where customer can request for specific services, and a product closer in the form of a bill system that actually does the fulfillment. But these apps are by themselves not monolithic. These apps contain a number of third-party products. So a vendor component or a third-party product, what if that fails, and then what impact can it have on the entire journey, right? And now, with cloud being a dominant theme across all enterprises, you probably end up, the bottommost layer probably is at the cloud, where, what if any cloud component fails or cloud goes down? Just 3 months back, there was an incident where the large cloud services were stressed out. There were several apps that went down because the cloud services failed. Now, with this being the complexity of a landscape, both on the IT side as well as on the third-party products, so there are a number of risks that come into picture. And as a risk manager, they need to have a tight hold on what is the type of IT risk they're getting into, because in digitization, there's a lot more technology involved. What are the third-party risk? What is the profile of the third-party risk nowadays? There are many open source components. The latest one being, everyone was shocked and were put into action when Log4j revealed that it had several vulnerabilities, right? Log4j is just an open source component, and most banks or even enterprises just unassumingly incorporate that into their entire IT landscape. But what if such components, which are really fundamental to IT systems, they have vulnerabilities, right? So similarly, there are a number of other risk disciplines that are impacted due to digitization. Could be new product development, could be compliance risk, cyber risk, data privacy risk, fraud risk, and there could be more, even to the extent of credit risk if the products that they're dealing with is actually in the business of lending money, right? Now, with all of these risks coming into picture, a risk manager needs to have a very tight line of sight between a customer journey to the most granular form of risk. And among all of these risks, it is the IT risk and possibly to some extent, the cyber risk, which have very, very complex, I would say, landscapes that are not really apparent to a risk manager, and they need to have a line of sight from top to bottom to understand what is, which part of the customer journey is exposed to which type of, potential failure, or, from where the risk is getting induced. And right now, that's a big challenge. And for digital transformation initiatives to sustain themselves, we need to have this going. And in the next slide, I'm going to explain why it is so important. Now, I told you about establishing a line of sight from customer journey till the nth level of component that's out there in the IT landscape, from a cyber perspective or just plain, IT risk perspective. Now, aligning IT risk to the business risk with a line of sight helps in several important, I would say, metrics that a risk manager would really care for. One is impact, exposure, and planning for resilience. Now, there are many things that are out there. So if a customer journey fails due to, some component failing, okay, what is the real impact on, the number of customers, the type of journeys they undertake, and that has an implication on the brand, on reputation, even on revenue, for that matter, right? And those types of metrics can be collected with a clear line of sight. The second aspect is automated risk assessments. Risk assessments have to be undertaken by risk managers periodically. It's either due to an event or because of a prior schedule. Now, with automated risk assessments, traditionally bank risk managers used to collect data manually where data was not really available. And from practical experience, I can say that only part of the data they need is readily available, and most of the time they go hunt for additional data set through surveys or through other means. And a clear line of sight will actually help source all of the data and do an automated risk assessment. So these risk assessments to a great extent can be automated, and then the risk manager can just view the results of such risk assessments and then decide what to do next. Right? In a traditional sense, this used to take a long time, but if we have the line of sight enabled, then these risk assessments can be on demand or when needed, right? We don't really having to wait for long. The next important advantage that they will get is the early warning mechanisms. Now, these early warning mechanisms are important for many reasons. Many times, if a particular component is expected to go down, right, it does not create any warning, but by monitoring such components proactively, you can create a early warning mechanism or notification by which you can then take remedial measures. Even if it is planned to go down, you can have an alternate solution in place so that the customer journey is not really impacted. So clearing and having a clear line of sight will also help get that early warning mechanisms in place, which were not really available right now. And the reasons why they were not really available is something like this. It's visually represented on the slide. Risk managers have, they rely on GRC systems, and GRC systems are the place where they broadly set up the entire firm for risk management purposes, like an entity. What are the various lines of businesses? What are the products? What are the geographies? So all these are set up, followed by the details of the products. What are the inventory of processes that are out there? Which products are linked to which processes? And because of this, what are the risks that are in that they are exposed to? Each entity geography is exposed to. And for each of the risks, what are the controls that are in place? And for each of these controls, what are the tests that are being executed periodically to assess if control is effective or not? And then finally, what are the potential issues and so on, right? So this is what generally a GRC system does. And having got all of these, we might think that, yeah, it's great, we can actually establish a line of sight because it's got everything. Unfortunately, GRC systems are more business focused, and the IT world resides generally in a totally different system. Like modern day examples being ServiceNow is one of the favorite tool for managing IT services and risk. And IT services and risk have their own, I would say, taxonomy, their own way of representing data, tracking issues. And the GRC system and IT service and risk management are generally not easily converging on a common data set or a common taxonomy. So that makes the alignment very difficult. And as it is, the two systems are by themselves, with very little integration between the two. So getting a clear line of sight from specific IT components to the risk and controls is highly challenging. The second part of this is a lot of data is actually in business systems and applications. When customers do transact, they're actually transacting on business systems and applications. A lot of data that is needed for risk assessment, controls, testing effectiveness actually comes from these business systems and applications. Now, GRC systems are not tightly integrated with, or in fact, GRC systems are generally not integrated with other business systems because there are hundreds or even thousands of such business systems and applications. It's not really practically possible to integrate everything with GRC in a traditional sense. But until unless we have some kind of a integration and a mechanism by which we can query all of these three together, we will not be able to get that line of sight. So a mechanism by which we can integrate all these three data domains is critical for a risk manager to get a clear line of sight. And that's what we believe that a graph technology is clearly suited for. So now that we have understood what really the problem is with respect to the digital risk management, why risk managers are at a disadvantage, now we'll talk about a new data paradigm that's actually espoused by graph databases and how this is going to be helpful. Now, I just described the three different data domains which are out there. How do we get them all together? And of course, right now, graph is one of the best way to get them all together and then establish a line of sight between different data domains. And a scalable graph database is absolutely essential because the volume of data that's embedded in each of these systems is, of course, on the highest order. We are talking about almost the entire enterprise, and we need to have some level of data from each of these data domains to be usefully represented in the graph. The second aspect is interconnectedness. Now, getting these data domains together means interconnecting these components, and interconnectedness is going to give us new insights like line of sight, right? Line of sight is possible only when we interconnect. The third aspect is flexible and powerful analytics, and this is especially useful when we have to do risk assessments, when we have to do early warning mechanisms, and a solution that has got graph algorithms and the machine learning algorithms together is a perfect solution to actually make a risk manager's job easy. The insights, the quality of insights that we are going to get are that much more powerful with this combination. Now, what kind of databases are relevant? Of course, no points for guessing. You all know what type of solutions that we might need, which have all these things in place. So let's take the same example of customer journey. If we were to take this customer journey, conceptually, I have represented that on the left. You have At the very highest level, we have defined the customer journey, followed by the type of people who are interacting with the customers, and they're being supported by the back office staff. And collectively, these employees of the firm are using systems, right? And these systems probably have third-party components embedded, and finally, the type of cloud services that they rely on. All of this, we got this on a graph. On the right-hand side is a sample graph where we took a sample customer journey, in this case, a bill pay journey, and we created the graph. And to our, I would say surprise, but it's an insight that we got, that this part, which is actually the customer journey, is actually supported by a very deep link of various components. And even if any one of them fails somewhere along the line, we have a whole lot of customer journeys that are getting impacted. This is the power of, I would say, a graph in giving this insight to a risk manager. They can now know if a component fails, is there a redundancy to this, right? They can plan their operational resiliency. They can plan backup mechanisms to see to it that the critical journeys are never disrupted. This is a zoomed version of the same graph. I've taken a small portion out there and zoomed it further to figure out what is represented. As you can see, we have represented a customer journey through these middle series of, I would say, nodes, which are connected through edges, right? So that's the customer journey, and it's connected through an app, and app is based, is in turn linked to various other components in between, right? So it is helping establish the line of sight from customer journey all the way to the minutest components that are involved in this customer journey. And we are able to, because of this line of sight, we are able to predict risks. We are able to do operations resiliency planning, and many others. So with this, what I would request is I'll turn it over to my colleague Shishir, who will now explain to us with an example as to how this works in a practical scenario. Shishir, over to you.
Thanks, Uttam. So taking the thought forward, how graph technology can play a big role in bringing desired transparency, focus, and speed in mitigating risk and making organizations more resilient. Based on our experience, we have put together a couple of illustrations. So the first illustration is building out a dependency from customer journey to physical infrastructure level. So we'll leverage the same payment journey, how a customer is planning to pay the bill and what are the steps, how the customer interacts with the applications, and then behind the scenes, how those applications interact with API services, then going to the database level, and ultimately going to the physical infrastructure level. We'll demonstrate how we can build this dependency map, bringing the desired transparency at different levels. So one level of abstraction is going to be for CROs, chief resilience officers or chief risk officers. One level of transparency will be there for a journey owner, as well as a process owner, systems owner, technology owner. But all of them have a consolidated single view of where the dependencies lie and what are the steps, what are the mitigation strategies they need to build in. The second example laid out in the slide, in the lower half of the slide, is how do we detect criticality of a failure? Say in a customer journey, something failed. How do we detect the point of failure, and how we propagate it upstream to finally determine whether that failure is critical to the overall customer journey, impacting the customer or not? So let's do a zoom in on the first one of them. So in the first use case, as you can see, right, we are looking at the pay bill journey. So that pay bill journey is broken down into some steps of a process, and it depends on some other processes. Here it is depending on pay bill through mobile or pay bill through web. And ultimately the cardholder user group is trying to make a payment. If you go to the next one. So now let's drill down at a process level. So if we blow up the pay bill through mobile journey, it has some steps. As a user, basic steps. As a user, I would unlock my phone, open the app, view the statement, maybe I'll view the history, pay the balance, and be done with it. But behind the scenes, some of these steps depend on different calls to different systems, APIs, whatnot, to enable this process. For example, as laid out here, once I open the app, I'm actually tapping into the API layer where I'm going to be authenticating myself either through biometrics or through my password, and I'll be using some features which are laid out here, like view payment history and make payment features. Going to the third layer. Now in this example, we are linking the features which are laid out to the users, to the supporting people layer, to the applications, API layers, APIs, services and calls which are made to enable this functionality, ultimately going to the database layer, and finally from database to physical locations where the servers are located, which are enabling this entire functionality. As a customer journey owner, right at the top, I may not have that visibility if all of these are not linked and lying in some silos. Say some physical location goes down for some time, I may not be able to realize whether that failure has any critical dependency or critical impact on my journey, and I'll not be able to bring the right people in to resolve it as fast as possible. Ultimately, the goal of the dependency map is to figure out where the fault lies as soon as possible, to identify who are the right sets of people who can help out and resolve this, and figure out if there is a way to do a graceful degradation before we move to a normalcy. Going to the second illustration, if we click on the first one, yeah. So here we are inducing a failure. Say database is out, it's not available. That's the point of failure. The red line, which is going upstream, is indicating which components of the journey are failing because of this particular failure. So we are propagating the failure upstream. The database is down. Because of that database, Trend API is not able to perform. And because of Trend API, the risk scoring service, although it has other components like geolocation API, etc., which are available, but the critical component, Trend API, is not available. Thus, risk scoring service is not available, which is rendering login service and biometric login service unavailable. So if you go to the next, Uttam. Now, with the login and the biometric service not being available, the fault propagates upwards. Authentication service is failed. Because of my authentication service failure, I'm not able to log into the app, I'm not able to view my payment history, and I'm not able to use the payment feature to make the payment. Thus, although in my overall journey, I may still open the app, I may still play around with my phone, but I'll still not be able to make the payment. Thus, there is a critical impact on the customer, and my payment customer journey is broken because of that particular database unavailability. Which is laid out here. Thus, the entire journey is marked as red. There is a severe impact on the customer, and because there is no alternate path available, there is no graceful degradation feature available or path available, this customer journey is going to be critically impacted. Now, as a CRO or as a customer journey owner, what I would like to know is pinpoint the failure immediately as soon as possible. So if I go through this dependency map, I would be able to identify, okay, this database failure is the reason why my customer journey is not available. Now, who are the right people who can help me out? Because I know in my dependency map, I have identified which teams are actually supporting this database. Where is it located? Is it a physical location failure, or is it an API failure? What exactly is the reason of that, and how it is moving upwards? And if I have an alternate route or a redundant path, which is enabling me to provide that service through maybe some reduced SLAs or not. I hope I'm able to demonstrate how a graph can help bring the desired transparency at different levels of the organization. Back to you, Uttam.
Thank you, Shishir. So that was a really eye-opening example. So anyone, a normal person, probably won't imagine the layers of dependency that are out there in an IT landscape. And this clearly articulated the depths to which you really have to link components to understand, where is the dependency and how to really plan the operations resiliency or even risk management. So overall, now it's pretty clear that we need to get all of these data domains together: a GRC graph, a IT assets graph, a business apps, really the business apps graph. So business apps by themselves, they'll be having their own way of logging. So you can call them logs or sensor data. So all of these can be brought together in a graph and then mined for information, right? And some of the cool parts of a solution will be to figure out the patterns of such behavior, see if we are really exceeding the risk tolerance limits or we are staying well within the risk tolerance limits. Maybe it can give us a warning that we are approaching the risk tolerance limit maybe in a week or a month. And that gives us enough time as risk managers to actually plan mitigation and any corrective action as needed, right? So there are predictive analytics that we can do. So even in terms of similarities, right? An event has taken place in a certain division, but can it take place in several other divisions? We can use the power of analytics on this combined data set to get things like IT health indicators, so we can predict which component is healthy and which component is not healthy. We can start from there. We can predict what its impact on application health is. So based on the application health, we'll know what's the impact on customer journey is. And based on the customer journey, we'll know, what is the extent of an operational loss event or just a kind of, it need not just be a loss, but it can be a event that's damaging enough, right? And finally, we monitor the business risk if it's there within the tolerance limits or not. So this way, a digital risk manager is now fully equipped to be able to react in seconds rather than in hours, days, or weeks in a fully digitized world. And business digitization should not leave behind the risk manager's digitization. And these are the key components a risk manager would definitely need to be successful in a digital world. So with this, we would like to conclude today's presentation. We hope it was enlightening and useful. And we are there to take questions if there are any going forward. Thank you.